The Prime Minister was cheering for more than just the coalition breaking up today. The Reserve Bank, of course, handed down its decision to cut the official cash rate by 25 basis points. That takes it to 3.85%. Governor Michelle Bullock said it wasn't an easy decision with so many unpredictable factors like trade wars flying around.
The key point about the situation we're in is it's not just uncertain, it's actually unpredictable. I'm not putting a strong possibility on a really, really bad outcome, but I think we have to be alert that there might be.
I'm joined now by Judo Bank chief economist Warren Hogan. Warren, if we didn't have the Trump tariffs, would we have had this rate cut, do you think?
Look, I think the global scene has certainly made it a lot easier for the board today. You look back at the last rate cut and the guidance they gave then, the way the domestic economy's played out, if anything, it's probably a little stronger, a little bit more employment, and it would have made it a more line-ball decision for sure. But it's quite clear from both the statement on monetary policy, their forecasts, and then the commentary from the governor that they are very worried about something going wrong in the global economy and getting caught with an interest rate that's above what they think is neutral or still in a restrictive setting.
So on that basis, should we expect further?
Well, I think that's the guidance that they've given. I think the governor's made it pretty soft guidance in the sense that they're forecasting inflation pretty much from now being close to target, and they're factoring in the market expectation for the cash rate to come down at least 3 more times. And they're sort of giving some credence to that. So I think in the back of their mind, they think if all goes well, they can cut at least 1 more time, if not 2. And of course, the governor's clear message is if things go badly wrong in the global economy, they will be cutting more than that. And the market will continue to price that as a risk.
Well, exactly how hard and fast would they cut? Because, of course, the risk is last time we ended up in a global problem, which, of course, was COVID, we cut really hard and then ended up with large inflation.
Well, that's it. We are in a very different inflationary setting to anything we've seen in the last 20 years. We're really having to go back to the 1980s and 1970s to be in that kind of world where if you get this wrong, you're going to get a pretty severe inflation consequence. So, look, I think they're going to be limited in how much they can cut unless it is a very dire situation. And when I mean dire, I mean we are going to have to be seeing people losing their jobs and unemployment going up, which at this stage, there's no sign of that. In fact, everything has settled down remarkably well in the last 3 weeks. And of course, we still do have this inflation and we have an economy producing jobs, albeit a lot of them public sector, but that is income out there. So I think for the time being, the best way to think about interest rates is they can come down a little bit more, but the Reserve Bank's ready to move more aggressively if things go wrong.
I'm sure viewers at home are happy to hear that. Warren Hogan, thank you so much for your time.